Question 1. An applicant for a life insurance policy is concerned about future premium payments in the event of total disability. Which rider would address this concern by ensuring premiums are paid if the insured becomes disabled? A. Accidental death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Payor benefit rider. Answer: B. Waiver of premium rider. The waiver of premium rider is specifically designed to protect a policy from lapsing if the insured becomes totally disabled by paying the premiums on their behalf after a waiting period, typically 3 to 6 months. This ensures the policy remains in force and its benefits are preserved even when the insured is unable to work and pay. It provides a crucial safety net, allowing the policyholder to maintain coverage without financial strain during a period of disability. This rider is a valuable addition for anyone concerned about maintaining their life insurance during unforeseen hardship. Question 2. Which life insurance policy is characterized by flexible premiums and an adjustable death benefit, allowing the policy owner to modify payments and coverage as needs change? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance stands out for its significant flexibility, allowing policy owners to adjust both their premium payments and the policy's death benefit to match their evolving financial situation and coverage needs. Unlike traditional whole life, which has fixed premiums, universal life separates the insurance component from the savings component, offering transparent cash value growth that earns interest. This adaptable nature makes universal life suitable for individuals who anticipate fluctuating income or changing family responsibilities, giving them universal control over their policy. Question 3. Under the entire contract provision, what constitutes the complete agreement between the policy owner and the insurer for a life insurance policy? A. The policy document, the application, and any oral agreements made during the sales process. B. The policy document and a copy of the original application. C. The policy document, the application, and all marketing materials used. D. The policy document and the agent's binding receipt. Answer: B. The policy document and a copy of the original application. The entire contract provision, a standard life insurance clause, explicitly states that the policy document itself and a copy of the original application constitute the complete and sole agreement between the policy owner and the insurer. This crucial provision prevents either party from introducing external evidence, like verbal promises or marketing brochures, to alter the contract's terms after it has been issued. By clearly defining the complete agreement, the provision ensures legal clarity and protects both the policyholder and the insurer from future disputes. Always remember that the written policy and application are the definitive word. Question 4. An insured dies 18 months after purchasing a life insurance policy, and it is discovered that they intentionally concealed a terminal illness on the application. How will the insurer likely handle this claim, assuming a standard incontestability clause? A. The insurer will deny the claim and refund all premiums paid, due to material misrepresentation. B. The insurer will pay the full death benefit as the incontestability period has passed. C. The insurer will pay the death benefit less any outstanding loans, but will not void the policy. D. The insurer will pay the full death benefit, but may pursue legal action against the estate for fraud. Answer: A. The insurer will deny the claim and refund all premiums paid, due to material misrepresentation. Most life insurance policies include an incontestability clause, which prevents an insurer from disputing the validity of the policy due to misstatements on the application after a certain period, typically 2 years. However, this clause has a critical exception for fraud, especially when it involves an intentional concealment of a material fact like a terminal illness within that initial period. Since the death occurred within the 2-year contestable period and involved intentional concealment, the insurer can rescind the policy, deny the death benefit, and usually refund the premiums paid. This protects insurers from applicants who deliberately misrepresent their health to obtain coverage. Question 5. What is the primary purpose of the Medical Information Bureau, MIB, in life insurance underwriting? A. To provide insurers with comprehensive medical histories of applicants, including detailed diagnoses and treatment plans. B. To act as a central repository for all prescription drug usage by insurance applicants across the country. C. To detect fraud and material misrepresentation by applicants during the underwriting process. D. To assess the financial stability and creditworthiness of life insurance applicants. Answer: C. To detect fraud and material misrepresentation by applicants during the underwriting process. The Medical Information Bureau, MIB, is a non-profit association that operates as an information exchange for life and health insurers, primarily to deter fraud and misrepresentation during the underwriting process. When an individual applies for insurance, the MIB records coded information about conditions reported to other member companies, allowing insurers to cross-reference data from new applications. It does not contain detailed medical records or diagnoses, but rather general health impairments, helping insurers confirm if applicants have withheld relevant health information previously reported to another member insurer. The MIB helps maintain the integrity of the insurance application process. Question 6. A parent purchases a life insurance policy on their child, naming themselves as the beneficiary. Which rider would ensure that if the parent becomes disabled or dies, the premiums on the child's policy would continue to be paid until the child reaches a certain age? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Payor benefit rider. D. Children's term rider. Answer: C. Payor benefit rider. The Payor benefit rider is specifically designed to ensure the continued coverage of a child's life insurance policy if the adult premium payer, like a parent or guardian, becomes totally disabled or dies before the child reaches a specified age, typically 21 or 25. In such cases, the rider waives future premiums on the child's policy, preventing it from lapsing due to the payer's inability to continue payments. This ensures the child's insurance protection remains intact, providing peace of mind to the parent that their child's coverage is secure regardless of unforeseen circumstances. Question 7. Which non-forfeiture option provides the highest amount of pure insurance protection for the longest period if a policy owner stops paying premiums? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Automatic premium loan. Answer: C. Extended term insurance. If a whole life policy owner stops paying premiums, the extended term insurance non-forfeiture option uses the policy's cash value to purchase a single premium term policy for the same face amount as the original policy for as long a period as the cash value will allow. This option provides the maximum amount of death benefit coverage for a temporary period. It is often the automatic default option if the policy owner does not choose another non-forfeiture option, providing immediate, full coverage for a limited time. Question 8. What is the primary characteristic of a Modified Endowment Contract, MEC? A. It is a life insurance policy that has been fully paid up after a certain number of years. B. It is a life insurance policy that fails the 7-pay test, resulting in less favorable tax treatment of withdrawals and loans. C. It is a life insurance policy designed specifically for high-net-worth individuals to avoid estate taxes. D. It is a term life insurance policy that automatically converts to a whole life policy after a specified period. Answer: B. It is a life insurance policy that fails the 7-pay test, resulting in less favorable tax treatment of withdrawals and loans. A Modified Endowment Contract, MEC, is a life insurance policy that has received too much premium relative to its death benefit, specifically failing the IRS's 7-pay test, which limits the amount of premium that can be paid into a policy within its first 7 years. When a policy becomes a MEC, withdrawals and loans are treated on a last-in, first-out, LIFO, basis for tax purposes, meaning gains are taxed first, and are subject to a 10% penalty if taken before age 59 and a half. While the death benefit remains tax-free, the altered tax treatment of cash value access makes MECs less flexible for accumulation-focused strategies. Question 9. An individual owns a participating whole life insurance policy and wants to use their dividends to increase the policy's death benefit and cash value without paying additional out-of-pocket premiums. Which dividend option should they choose? A. Cash payment. B. Reduction of premiums. C. Paid-up additions. D. One-year term option. Answer: C. Paid-up additions. The paid-up additions dividend option uses the policy's dividends to purchase small, single-premium whole life insurance policies that are fully paid for and add to the original policy's death benefit and cash value. This option is popular because it continually increases the policy's overall value and provides additional insurance coverage without requiring any further premium payments from the policyholder. Essentially, the dividends are reinvested to grow the policy's benefits, making it an excellent way to compound growth over time. Question 10. When an annuity begins making regular payments to the annuitant, it is said to be in what phase? A. Accumulation phase. B. Surrender phase. C. Annuitization phase. D. Investment phase. Answer: C. Annuitization phase. The annuitization phase, also known as the payout or liquidation phase, is when the accumulated funds within an annuity contract are converted into a stream of periodic income payments to the annuitant. This phase follows the accumulation phase, during which funds were deposited and grew tax-deferred. Once an annuity is annuitized, the payments begin, providing a guaranteed income stream, often for life, and the original lump sum is essentially liquidated over time. Question 11. Which of the following statements is true regarding policy loans from a whole life insurance policy? A. Policy loans are considered taxable income if not repaid before the insured's death. B. Policy loans are not taxable as income, but unpaid interest reduces the death benefit. C. Policy loans are only available after the policy's cash value has exceeded the total premiums paid. D. Policy loans require collateral other than the policy's cash value. Answer: B. Policy loans are not taxable as income, but unpaid interest reduces the death benefit. Policy loans taken from the cash value of a whole life insurance policy are generally not considered taxable income because they are viewed as a debt against the policy's cash value, not a distribution of earnings. However, interest is charged on these loans, and if the loan and any accrued, unpaid interest are not repaid by the time of the insured's death, the outstanding balance will be subtracted from the death benefit paid to the beneficiary. This makes policy loans a flexible, tax-advantaged way to access cash value without surrendering the policy, but it's important to remember they reduce the death benefit if not repaid. Question 12. A life insurance policy names "my children" per capita as beneficiaries. If one of the insured's 2 children predeceases the insured, leaving 3 grandchildren, how will the death benefit be distributed? A. The death benefit will be divided equally among the surviving child and the 3 grandchildren. B. The death benefit will be divided equally between the 2 children, with the deceased child's share going to their estate. C. The entire death benefit will go to the surviving child. D. The death benefit will be divided into 2 equal shares, with 1 share going to the surviving child and the other shared equally among the 3 grandchildren. Answer: C. The entire death benefit will go to the surviving child. When beneficiaries are designated per capita, it means by the head or by person, and the proceeds are distributed equally only among the living beneficiaries named at the time of the insured's death. If a named beneficiary predeceases the insured, their share is forfeited and typically distributed among the remaining living beneficiaries. In this scenario, since 1 child predeceased the insured, the entire death benefit would go to the sole surviving child, as the grandchildren are not specifically named beneficiaries and per capita does not provide for generational distribution. Question 13. Which of the following is an example of an unfair trade practice known as rebating? A. An agent misrepresents the terms of an insurance policy to induce a client to purchase it. B. An agent shares confidential client information with a competitor. C. An agent offers a prospective client a portion of their commission as an inducement to purchase a policy. D. An agent makes disparaging remarks about a competitor's financial stability. Answer: C. An agent offers a prospective client a portion of their commission as an inducement to purchase a policy. Rebating is an illegal and unethical practice in insurance where an agent offers a prospective client something of value not specified in the insurance contract as an inducement to buy a policy, most commonly a portion of the agent's commission. This practice is prohibited by state laws to ensure fair competition among agents and to prevent discrimination among policyholders. Such an offer would unfairly incentivize a purchase, potentially compromising the client's best interests, and it is a serious violation of insurance regulations. Question 14. An employee terminates their employment and wishes to continue their group life insurance coverage without having to prove insurability. What option is typically available to them? A. They can continue the group policy as an individual for the same premium. B. They can convert the group coverage to an individual permanent policy without evidence of insurability within a specific timeframe. C. They must apply for a new individual policy and undergo new medical underwriting. D. They can transfer the group coverage to their new employer's group plan. Answer: B. They can convert the group coverage to an individual permanent policy without evidence of insurability within a specific timeframe. Group life insurance policies commonly include a conversion privilege, which allows an employee terminating employment to convert their group coverage into an individual permanent life insurance policy, typically within 31 days, without needing to provide evidence of insurability, i.e., without a medical exam. While the premium for the individual policy will be higher due to individual underwriting and typically a higher attained age, this privilege ensures continuous coverage and protects individuals who might otherwise be uninsurable due to health changes. It's a key benefit of group life insurance. Question 15. A client wants life insurance that will provide a death benefit if they die within a specific period, but also wants the policy to pay out a lump sum if they survive to the end of that period. Which policy type best fits this description? A. Whole life. B. Term life. C. Universal life. D. Endowment policy. Answer: D. Endowment policy. An endowment policy is uniquely characterized by its dual payout feature. It pays the face amount as a death benefit if the insured dies within a specified term, and it also pays the face amount to the policy owner if the insured survives to the end of that same term. This means the policy is guaranteed to endow or pay out at a specific date, either upon death or at the end of the term, whichever comes first. It's distinct from pure term insurance, which only pays upon death during the term, and whole life, which pays upon death whenever it occurs. Question 16. What is the standard grace period for a life insurance policy, during which the policy remains in force even if the premium is not paid on its due date? A. 7 days. B. 10 days. C. 21 days. D. 31 days. Answer: D. 31 days. Most U.S. life insurance policies include a standard grace period, typically 31 days, following the premium due date. During this grace period, the policy remains in full force, and the coverage continues even if the premium has not yet been paid. If the insured dies during the grace period, the death benefit will still be paid, though the overdue premium will be deducted from the proceeds. This provision provides a crucial safety net for policy owners, preventing immediate policy lapse due to a slight delay in premium payment. Question 17. An applicant has a medical history that indicates a higher than average risk of mortality, such as a controlled chronic illness. How would an insurer typically classify this applicant? A. Preferred risk. B. Standard risk. C. Substandard risk. D. Declined risk. Answer, C. Substandard risk. An applicant classified as a substandard risk presents a higher than average risk of mortality to the insurer due to factors like a chronic illness, hazardous occupation, or dangerous hobbies. While still insurable, the increased risk means the insurer will typically charge a higher premium to compensate for the greater likelihood of a claim. This classification allows insurers to provide coverage to individuals who might otherwise be uninsurable while maintaining actuarial soundness. Question 18. Which life insurance policy type offers the lowest initial premium for the greatest amount of death benefit coverage? A. Whole life. B. Limited pay whole life. C. Annually renewable term. D. Universal life. Answer, C. Annually renewable term. Annually renewable term, ART, insurance offers the lowest initial premium for a given amount of coverage because it provides pure protection for only 1 year, with no cash value accumulation. The premium is recalculated and typically increases each year as the insured ages, reflecting the increasing mortality risk. While it starts very affordable, its cost can become prohibitive over time, making it ideal for short-term, maximum coverage needs rather than long-term financial planning. Question 19. A policy owner needs to obtain a loan for a new business venture and assigns their life insurance policy to the bank as security for the loan. This is an example of what type of assignment? A. Absolute assignment. B. Collateral assignment. C. Vested assignment. D. Revocable assignment. Answer, B. Collateral assignment. A collateral assignment is a temporary and partial transfer of ownership rights in a life insurance policy to a third party, typically a bank or lender, as security for a debt or loan. Under a collateral assignment, the policy owner retains most of their rights, but if the loan is not repaid, the lender has a claim to the policy's cash value or death benefit up to the amount of the outstanding debt. Once the debt is repaid, the assignment is released, and full rights revert to the policy owner. Question 20. Which life insurance policy option allows the policy owner to receive a portion of the death benefit while the insured is still alive, typically due to a terminal illness? A. Waiver of premium. B. Accelerated death benefit. C. Automatic premium loan. D. Guaranteed insurability. Answer, B. Accelerated death benefit. The accelerated death benefit, also known as a living benefit, is a policy feature or rider that allows a policy owner to access a portion of the policy's death benefit while the insured is still alive, usually upon diagnosis of a terminal illness or other qualifying conditions like critical or chronic illness. These funds can be used for medical expenses, hospice care, or any other needs, reducing the eventual death benefit paid to beneficiaries. It provides financial relief during a difficult time, leveraging the policy's value before death. Question 21. Which life insurance policy covers 2 or more lives and pays out the death benefit upon the death of the first insured? A. Survivorship life. B. Joint life. C. Family income policy. D. Modified whole life. Answer, B. Joint life. A joint life policy, often called a first-to-die policy, covers 2 or more individuals, typically a married couple or business partners, and pays out the entire death benefit upon the death of the first insured to die. Once the death benefit is paid, the policy terminates. This type of policy is commonly used to provide funds for surviving spouses or business partners to cover expenses, debts, or buy out the deceased's share of a business. Question 22. A life insurance policy includes a provision that states if the insured commits suicide within 2 years of the policy's issue date, the insurer will only return the premiums paid. What is this provision called? A. Incontestability clause. B. Suicide clause. C. Misstatement of age clause. D. Reinstatement provision. Answer, B. Suicide clause. The suicide clause is a standard life insurance policy provision that specifies how the insurer will handle a claim if the insured dies by suicide. Typically, if suicide occurs within a certain period, most commonly 1 or 2 years, from the policy's issue date, the insurer's liability is limited to a refund of the premiums paid, without interest. If the suicide occurs after this period, the full death benefit is usually paid. This clause is designed to protect insurers from anti-selection, preventing individuals from purchasing a policy with the intent to commit suicide. Question 23. If a whole life insurance policy lapses due to non-payment of premiums, and the policy owner takes no action to choose a non-forfeiture option, which option is typically automatically activated? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Automatic premium loan. Answer: C. Extended term insurance. In most whole life policies, if the policy owner stops paying premiums and does not select a specific non-forfeiture option, the extended term insurance option is automatically activated. This option uses the policy's accumulated cash value to purchase a single premium term life insurance policy for the same face amount as the original whole life policy, for as long a period as the cash value will allow. This ensures the policyholder continues to have coverage for a period, preventing the policy from simply terminating without any benefit. Question 24. What is the primary tax treatment of the death benefit paid from a life insurance policy to a beneficiary? A. It is always taxable as ordinary income. B. It is generally received income tax-free by the beneficiary. C. It is taxable only if the beneficiary is not a direct family member. D. It is subject to capital gains tax. Answer: B. It is generally received income tax-free by the beneficiary. The death benefit paid from a life insurance policy to a named beneficiary is generally received income tax-free. This is one of the most significant tax advantages of life insurance and a key reason it is used for estate planning and financial protection. While the death benefit is income tax-free, it may be subject to estate taxes if the insured's estate exceeds certain thresholds, but the beneficiary usually does not pay income tax on the proceeds. This allows the full value of the death benefit to provide financial security. Question 25. An agent helps a client purchase a new life insurance policy, but then recommends that the client surrender an existing policy from another insurer to pay for the new one. This practice might be considered what? A. Twisting. B. Rebating. C. Coercion. D. Defamation. Answer: A. Twisting. Twisting is an illegal practice in which an agent or broker persuades a policy owner to surrender, lapse, or otherwise terminate an existing life insurance policy in order to purchase a new one, to the detriment of the policy owner. This usually involves misrepresenting the terms, advantages, or disadvantages of either the existing or the proposed policy. Twisting is prohibited because it can strip the policy owner of valuable benefits like lower premiums based on original issue age, cash value growth, and favorable clauses, solely to generate a new commission for the agent.